Welcome to the Toronto Real Estate Podcast. My name is Kori Marin. I'm a broker and a co-founder at Fox Marin. And today we're sharing a smattering of some of our top viewed episodes from 2024, some key moments for you. Should you wish to skip to a particular segment, we have the chapters ready for you in the show notes below. Segment 1, Ralph and our good friend Steve Keyzer from Colliers discuss whether Toronto's real estate market has reached its lowest point, focusing on buildable square foot costs and market recovery predictions. Segment 2, Ralph and I highlight the potential growth in the semi-detached segment in Toronto, the impact of these new lending rules, and key indicators for the 2025 market. Segment 3, Matt Young from Republic Developments and Ralph analyzed the affordability crisis, overtaxation, and the need for government action to address supply constraints. Segment 4, Ralph and I examined condo prices, inventory shifts, and market resilience over the last decade or so. And number 5, finally, our good friend, mortgage broker Jason Friesen and Ralph Fox explore economic realities of rate cuts, inflation, and their impact on Toronto's housing. Thank you so much for tuning in. It's great to see all of you. We love your feedback. Post them in the comments section anytime. We'll be sure to respond to you there. Have a great start to your weekend, and we will chat soon. I hope you enjoy the recap.
And what are you seeing, the trades that you are seeing? Like, what are you seeing buildable per square foot right now?
Well, in the high, we sold a site at Charlotte and Adelaide at a receivership. I remember it closed July 2022, just before the interest rate hike started. And we sold that site and another one at Peter and Richmond at in around $300 a buildable square foot.
Right.
Today, you're probably looking, depending on the location, anywhere from $100 to $150 a buildable square foot.
That's a big drop.
It is. It's more than 50%, and that's why I'm screaming from the rooftops. Like, land has never been cheaper relatively in Toronto.
Yep.
And I think that in 3 to 5 years, there is going to be recovery. But buyers are cautious. Vendors are still optimistic because 24 months ago, those were the numbers, or 2.5 years ago. And so they're rolling the dice and they're saying, I'll see the next hand and we'll see what interest rates do. But interest rates have not come down as fast as they would have expected. So you're seeing a little bit of capitulation on the vendor side. And that includes, you have a bunch of receiverships and banks. Various banks are okay. Various are, they're first position land loaned. They're not getting full recovery on. So, we haven't dealt with this since the early 90s, and most people in the business weren't in the business at that time.
Yeah.
So they really don't want to take this bad news upstream and say, we got to take a loan loss here. So they're rolling the dice, a lot of them, but some of them are capitulating now and realizing this is a medium-term slowdown, not a short-term slowdown.
And so it sounds like we're at a bit of a stalemate right now because $1 billion, dollars sounds a lot, but in the world of real estate development, that's not a lot of transactions. By way of reference, in a matter of years, going from 18 billion now to 1. And it seems like because pre-construction sales and demand, which what drives the market, are basically at a standstill as well. It sounds like the whole development world, from the front end sales to the bottom end sales, it seems like we're basically at a standstill. Is that correct way to look at that?
Yeah, and if I'm a young buyer and I have some money, I would say now is the best time you will have in probably the next decade or longer to get into the market with condos, with the assignment market, with product that's being built and completed and unsold. I think you can negotiate right now. So notwithstanding, you may have not expected interest rates to remain this high. I would buy on a 1-year mortgage rate, get a great number, hopefully, depending on the situation, and then refinance in 12 to 18 months. So I would be aggressive and in the market right now, but that's not. It's a herd mentality on all sides, being individual condo buyers and land buyers. Once it's on. But right now it's not on. And so if I'm a buyer of both, I'm being aggressive.
Goes back to Warren Buffett old adage, right? Be greedy when people are fearful, and fearful when people are greedy. And it takes a lot, whether, you're looking to buy that first property and swing a $700,000, $600,000 purchase, or a $500 million purchase to pony up when there's blood on the streets, when everybody is nervous. And it seems like a real easy thing to do, but yet with emotions and uncertainty, and is this the true bottom or could there be another leg to go down? There's a lot of fear. And it's interesting just thinking about this conversation, seeing it in context. It seems to be no different in a lot of ways. A first-time buyer versus you sitting down with a very large experienced developer screaming it's $125 buildable a square foot. What a great time to get into an opportunity. And so it seems like right now this is happening just across the board, which is really interesting when you think about it.
Yeah. I mean, Stephen Schwartzman, the founder of Blackstone, if you haven't read his book, you should get an Audible
Great
too.
book.
But he always talked about, I always get in the market when it's recovered by 10%, right? You don't want to call the bottom. And I feel like everyone is imploring that right now, that they don't want to catch a falling knife or, buy and then it gets worse. But I would think you're kind of insulated, even if it gets a little bit worse. It can't get much worse, in my opinion, without government incentives and government intervention. So I would say we're at or near the bottom. Maybe it goes down another 10%, but I don't think it can go any lower without the government stepping in and taking real action. Because the incentives that have been put in place recently, they're just for headlines. They don't really move the needle because we're running the numbers every day on these development sites. And the recent announcement on DCs, they're waiving DCs on rental, but
for
development charges.
Yeah.
But they're requiring 20% affordable housing in exchange for those DC waivers, which basically maybe puts you a little bit ahead on the pro forma, but it's not earth shattering in terms of creating the real margin that is required.
Someone's going to have to pay for the affordable housing. That's the issue. And the government's just trying to offload those costs. So it is really interesting to see this happening across the board, knowing, you would have resale being the first mover that's going to see things open up. Pre-construction sales will follow resales, and then the development world will follow. What we're seeing on the resale side of things is we're definitely seeing a slight uptick.
All right, let's look at prices, because prices is the most fun part. Again, this is very obvious to see that we are up in terms of the average price for a semi-detached over the last 10 years. In fact, if you bought a semi-detached house a decade ago, prices are up 75%. If you purchased a semi-detached home 5 years ago, prices are up 13.8%. And if you purchased a semi-detached home in the height of the insanity in 2021, prices are only slightly down, about 0.3% versus the height of this time period in this category specifically. So if you're often in bed at night worrying like, why was I the one person that bought during that time period and now I'm suffering the consequences, you're going to be just fine. And it looks like things are already springing back. And we anticipate and forecast, as Ralph mentioned earlier, that we're going to see this category get very competitive as we see the lending rules take a strong shift effective December 15th. So Ralph, you're always the best when it comes to talking about policy change. So why don't we highlight that here?
Yeah, I mean, we talked about this on our last podcast last week, but maybe looking at it from a slightly different light is mid-December, the federal government has changed the lending rules for insured mortgages, meaning if you're putting less than 20% down, the cap is currently $1 million. That cap is going to be lifted from $1 million to $1.5 million. In addition to that, you will have the opportunity under this new guidelines to get a 30-year AM as opposed to the 25-year AM, which will help stretch out the payments a little more. And so why that's relevant is, as anybody who's watching this podcast knows, I'm sure, it's very difficult in central and downtown Toronto to be able to afford to buy a house for under $1 million. Well, now you could buy pretty much most semis in the city under this program. Now, this isn't for everybody because there's going to be huge carrying costs involved if you're looking at putting less than 20% down and carrying a mortgage under this program significantly higher than if you had put 20% down and didn't have to pay the insurance premiums, etc. However, there are a lot of buyers out there, or there's enough of them out there, who may not have that down payment, but they have very strong incomes, and generally they will be couples, most likely without kids, with very little expense. And so those are the ones that these type of programs, I think, will be aimed at. And what we are expecting is that entry-level freehold home, not necessarily detached, more meaningfully semi-detached and row homes, all of a sudden opening up a whole new type of buyer. And what we're seeing in the market right now is in anticipation in that jump in demand and potential price appreciation, we're starting to see that market, part of the market, heat up. And if you're looking for a leading indicator in the Toronto real estate market going into 2025 and in the first quarter of 2025, keep your eye on the semi-detached and keep your eye on the row homes, because that's where we expect to see the strongest price appreciation growth.
100%. And just to be clear, if you are buying a house, let's just use October's average. So October 2024, an average semi-detached house is $1.3 million. You need a 20% down payment, and that is just over $260,000. So not everybody's running around with that type of cash at their disposal. And then on top of that, you've got your land transfer taxes, which can't be rolled into your mortgage, which is a big nauseating just dump of money that you'll never get back. And nor will you ever be like, I'm so glad I paid those double land transfer taxes. And because I did, I feel like we have amazing roads and infrastructure now because I put that big chunk of change towards that. You'll never have that conversation with yourself, I guarantee. It will be really interesting to monitor these categories. And I look forward to just briefly touching on row houses as well, because they tend to hover just a little bit lesser in terms of their average pricing. And then I also just want to be very clear that this is covering a massive geography when it comes to semi-detached. So if you're looking at trendy neighborhoods where people want to be living in this type of property, like your Leslievilles, your North Riverdale, your Plater Estates, Trinity Bellwoods, Little Italy. I mean, your semi-detached are creeping much higher than these averages. And you're looking at like your 1.5s and 1.6s up into like the 1.8s, depending on the quality of the renovation and or size of the property as well. So this isn't really a palatable number to indicate what these like key downtown neighborhood expenses are like for semi-detached in this category. All right, just moving just quickly on listing days on market. So again, we've just seen the lever pulled back in terms of how quickly things are selling or not selling as quickly in this category. So we're up about 48% versus last year. So things are taking a little bit longer to sell. You can see that here. And as we've discussed these changes, we expect, and it'll be interesting to monitor if things start moving through the system faster as we see these changes to the lending rules. And then quickly here, months of inventory. This is always something we want you paying attention to if you want to become really educated about Toronto real estate and you're a data-driven person. Monitoring inventory is something that we would really encourage you to look at. This is always going to be the way that you can measure supply and demand. This just comes down to basic economics right here in this graph. And as you can see, leading up into like October 2021, we had no supply in this category. We were hovering around 1 month of supply in the semi-detached category. We've creeped up. We know why. Interest rates, the cost to acquire, the cost to carry obviously went up. So you can see that things slowed down in October 2022 and October 2023, where inventory actually crept up to almost 2.5 months of supply in this category, but already we're seeing a drop. So look at last year, look at this year, and we're down 17% in inventory in this category. And I do think the next time that we look at these numbers, Ralph, on the podcast, we'll be reporting less supply in this asset class. That's my prediction for this.
The problem that I see, and it's something that you were touching upon, is there seems to be this desire, either from the media or from politicians at all levels of government, where they're always looking for a scapegoat. If it's foreign investors, well, it's easy to point at them because they can't vote. Or it's evil investors, or it's greedy developers, or it's real estate agents. It just seems like they're always looking for the boogeyman rather than having the real conversation. And that conversation is that we're all overtaxed and it's really constraining supply because it's making affordability just out of reach. And so until we're in a position where we can have those real conversations, and that's really why I wanted to have you on this on our podcast, because I think it's really important to be having this conversation. And I really, really commend you for taking the initiative to try and bring this to the forefront, because it's something that needs to be discussed, and it really isn't right now. And so when you see politicians and when you see people talking about affordability, we have 30% to play with, a margin that could be affected almost overnight if there was some real action that politicians on all levels wanted to have. And the only way that's ever going to happen is by bringing this into the discourse, so into the conversation. So I think what you're doing is amazing. And there's a lot of people in our industry who completely agree with what you're saying, because we're seeing it and dealing with it every single day.
Yeah, for sure. And thankfully, the conversation is shifting. We launched our campaign back in August. We got a ton of press and a ton of media. That has then since worked its way through the industry. Build, which is our kind of government lobby group, they have launched now their own campaign to talk about taxes on housing. And so I think they launched a couple of weeks ago, and they've got a great media budget that they're pushing out there. So they're pushing their own conversation. We've got a follow-up to our campaign, hopefully coming out later in October, if all goes well, which will again try and, I think the goal of our follow-up campaign is to really resonate with the general public. The first campaign was really speaking to government. The second campaign is now going to be trying to speak to the public to help them understand what the problem is. Because I think ultimately government's not going to act until enough people reach out and enough people put pressure on them and they start to feel it. When election time comes, this is an issue that people want us to address. We need to come up with some solutions to address this. And so, our goal is just to be relentless about this and keep the conversation going until we start to see some action.
Relentless is one of our core values at Fox Marin. If there's any way that we can help participate in your push in October through our channels, we'd be happy to do it, because we really feel that this is an important message, because it's a real problem, the affordability issues, and you're seeing it have a trickle-down effect through our entire society. And there's a lot of stress that's being magnified because of this. And you're really getting to a point where the idea of the haves and the have-nots is really starting to diverge. And you're seeing that through real estate. And it's one of the things that I talk about and have thought about a lot over the years. Is it's almost like feudalism in Europe, where generational wealth is being passed down through real estate. Whereas if you're graduating school and you have student debt and you're making $75,000 a year, in this current environment, how are you ever going to catch up? And the question is, you might never be able to.
Yeah, it's very tough. And like I talk to friends and other young people, you start to see like they're forming families much, much later in life. Many are opting not to have kids. It's causing these trickle-down effects throughout our society, as you pointed out. Many of those things are actually much worse. Like if we, I saw a stat that if our population numbers or our reproduction numbers stay at the same pace, I think over 3 generations, like we'll have population collapse.
Yep.
That's a big problem. How are you going to sell your mansion when there's nobody there to buy it? So like a lot of the asset values and everything here are based on a society that continues to grow. And you've created an environment where young people don't want to invest. They don't want to take on risk. They don't want to start a family. They're just kind of operating, from this scarcity mindset. Again, it's not a healthy way to live. It's not a healthy way to run a country. And so I think government has to kind of clue into the bigger picture here, which is that we need people to want to live here and plant roots here and invest in their future. And to do that, it starts with housing. Like if you're paying 50% of your salary to rent an apartment just to get by, and like, that's not a way to live. Why would you do that? Go to Bali. You don't need to be here.
Bali sounds nice right about now.
But like, I half joke about it, but if your alternative is like live a kind of miserable life here where you can't afford anything, or, you know, go somewhere else and just like fully check out. But it's like, you're almost making a choice. I'm checking out of the system and that's what's going to be my life. But if you're not going to have a family and kids and invest in something and try and build something here for yourself because you just don't feel there's an opportunity, then you really shouldn't stay here. You shouldn't stay here and try and stick it out. Like, what's the point? You may as well just go enjoy your life. You only get one shot at this.
So what keeps you engaged? What keeps you here? What keeps you pushing forward? What keeps you pushing this initiative? What keeps you driving Republic?
I love the business. I love building housing. I love the creative aspect of it. You know, I've said this before, but I enjoy type 2 fun, which is like when you're doing the thing, it's not fun, but when you're finished doing the thing, it's really fun.
Yeah.
And real estate development is very much that type of, that's like a job specifically designed for people who like type 2 fun, because it's painful the entire way through. You just deal with setback after setback. A friend of mine who works for another developer, he once described it as continually being punched in the face and continuing to walk forward. I enjoy the kind of the journey and the challenge of trying to make things work. And that makes me happy. So yeah, for me, this is great. But like, I'm in a better place than most, you know. I'm a little bit older. I think I was able to buy a home when it was more affordable. You know, I still live in a condo. It's not like I'm living the life of luxury. I live in a condo. Live a fairly normal life. I've got my business and I love, you know, what we're doing. So that keeps me going. But I could easily see how a lot of people wouldn't
100%
have that and would be like, why am I continuing to do this? So, and by the way, I'm not advocating for people to like check out of Canada and leave. What I'm actually saying is government, like this is what people are going through. You need to start paying attention to this. This is a much bigger issue than you are appreciating, and something needs to be done. And I think, you know, we've got such a smart, you know, talented group of, young population, but like you can't take everything away from them and expect them to then, you know, invest in this country. You have to give them a real shot.
3 things you would do if you were in control of, forget the level of government, but let's just say you had the ability to change and affect things overnight. Could be real estate, could not be real estate. It could be whatever you would do. What would the 3 things be?
I think number 1 would be cutting taxes, both real estate and general taxes. I think I would be going back to a more stable level of immigration. I would also focus immigration on what we need in this country. Mm-hmm. So I would be focusing on trying to get people, you know, who have money, who want to invest and build a business, labor where we need, you know, we need a lot of construction labor to help build this country. There's a lot of investments we need to make, people like that. I would be putting them at the front of the line. And what would be a third? Lower taxes, probably change immigration. And I don't know, I can't think of a third right now, but those 2, I think alone probably move the needle quite a bit, right?
I think so.
Like you don't have to, I mean, you know what it would be? Probably removing a bunch of regulation, a whole bunch of regulation. There's way too much regulation in everything. And I'm not saying like, you know, don't have like a, you know, regulation on food or things like that. But I'd probably strengthen regulation there, but I would just remove regulation, make it easier for people to do stuff, remove some of the burden and some of the roadblocks, make it so Canada is the easiest place to set up a business, the easiest place to invest in, make it so money wants to come here. The way you grow an economy is you want foreign direct investment, you want people investing in this country, you want more money flowing in than is flowing out. So let more money flow in, make it easy for money to flow in here and make these investments. And you'll see our country grow again.
You have my vote.
I would be a terrible politician, by the way.
So would I.
Never get elected.
I agree with
an absolutely terrible politician. The media would rip me up. It would not be good.
Well, I would agree with all three of those policies, and whoever would run on that platform would get my vote then. Last question, just want to wrap up. I know the condo market is struggling. I'm seeing it every day. I look at the comments in our YouTube section, on our YouTube channel, and everybody's just dying for it to crash. I don't believe it's going to happen. And I think we're turning the bend. But I just would like to turn around that corner. But I'd like to get your opinion where you think things are at the condo market, resale and pre-construction, and let's say where you think they'll be by 2030.
We talked about where things are at. The resale market is slow, but pricing has come down quite a bit. And I actually think there's good value in the resale market right now. Mm-hmm. So I think people who are looking to buy their first home, it's probably a pretty good time now or in the next 6 months as interest rates continue to drop. It's probably a good time to be looking at the resale market. Pre-construction is a little bit tougher because pricing is higher. Now, look, you get a brand new product, the design is fresher, less maintenance issues, things like that. But I still think there's enough of a gap that it's going to be a hard sell for a lot of people, for a lot of projects. There's some projects that maybe are in a slightly better financial position to be able to have pricing lower. But for the most part, I think that market is going to be tougher for a little bit longer. That being said, I do think by 2030, the market's going to be, I suspect, much higher. And the reason for that is because we still have a very high level of immigration. Most people, especially in Canada, want to move to Toronto. Like new immigrants coming here, Toronto is sort of like the number one spot everybody wants to go. Mm-hmm. And then you have 2 or 3 other cities that pick up a lot of the other immigration, and then kind of you get the rest of it scattered. But it's not like the U.S. where there's like 40 different cities that you can move to that are all amazing. Like in Canada, we're a little bit more concentrated. So because of that, I think there's always going to be demand in Toronto. And because of this slowdown we've had over the last couple of years, and I think, there's maybe another, let's say, year of a slowdown, maybe 6 months to a year, depending on how people respond to interest rates, that whole period where projects have not been starting construction or where starts have slowed substantially, it's going to mean by 2027, 2028, there's going to be no supply on the market. Yeah. And we're going to go right back to, bidding wars and people bidding up housing because we just won't have enough of it. So, and this is one of the things government needs to really be careful of is you can't have these like massive swings. Like I know it sounds great to say, okay, let the system, blow off and then, prices will all come down. Like it just doesn't work that way for pre-construction. Prices won't come down. You just won't build. And that's what's happened now. We're just not building. And if you do that long enough and you underbuild the housing, we're already underbuilding housing. So if you then further underbuild housing and you maintain a level of immigration that we have, it's just going to make things a lot worse. So I actually think now is probably a good time to invest in real estate. It doesn't sound like it's the greatest time, but what's the saying Warren Buffett had? I think it's be greedy when others are fearful and fearful when others are greedy. So, a lot of people are fearful right now. I think, if you have long-term conviction in Toronto, I think now is not a bad time to be looking.
A 1-bedroom condo in 2030. We've asked this question to a lot of guests. Everyone seems to come out around the same number. What do you think?
How many square feet?
600 square feet.
2030. I think you're over $1 million for sure.
Thank you. I've said that. We've had so many, and usually the comment section will blow up because of that. So hopefully you set it on fire, but that's kind of where I see things going as well.
Okay, so here are average sales. Everyone's favorite slides. Always comes down to price, right? And again, we're talking about all condo sizes here. Just want to be very clear about that, looking at the last decade. And so, of course, if you bought a condo in October 2015 compared to now, you're doing just fine. If you bought a condo in October 2020, you're even doing just fine. It's only been the last 3 or 4 years where we've just seen these prices hovering in the 700s. And in fact, we're a little bit down about 19,000 from October 2020 in the height of the craziness. So the fact that we're only down just less than 1% versus last year at this time on condo pricing, just still, I know we've talked about this on our former podcast last week, it just kind of does blow my mind. And, we get inundated with all this information too, the fear mongering in the media, other agents talking about it, buyers freaking out, people crying on the phone, like everyone having a bit of a condo meltdown. We also feel it too. We own multiple condos in our portfolio, so oftentimes we're concerned about it. And to see this, you're just like, okay, I can take a nice deep breath. We think things might be slowly turning around. And again, this is all very preliminary forecasting right now. We don't have a crystal ball, but these are healthy numbers to see considering everything that's been thrown at the market.
I think this is such an important slide to look at because if you bought a condo October 2019 and the day you closed, I would say to you, next year, there's going to be a global pandemic. Interest rates are then going to shoot up in 18 months or 2 years, the fastest they've ever gone up by 500 basis points. We're going to throw in a foreign buyers ban. We're going to throw in capital gains, tightening on the capital gains rules. We're going to put vacancy taxes in. We're going to put anti-home flipping taxes in. And we're going to do all of these things to the market. And what would you guess, with all of that being done to the market, the price of your condo would be? You would probably think it would be 50% less. And if we said to you, actually, your $668,000 condo is now worth $721,000, you would be like, oh my goodness.
Thank God.
Thank God. So this just is a testament to the resiliency of the condo market, given how much it's been stress tested and what it's had thrown at it. That doesn't mean that things could be different in the future or that there isn't going to be a crash in the future. We don't believe there's going to be one. But if it's gone through what it's gone through and it's still performed this way, this is just something to keep in mind versus the fear-based narrative that's always being purported out there in the mass media.
Yes, 100%. And then finally, just one more checks and balances here. And this is the inventory piece that we keep speaking to, which is very, very interesting. And again, we're comparing the last 10 years, October over October, all condo sizes here. And you can see the ups and downs of inventory. But what I want to highlight here is looking at last year at this time, we had 5.5 months of supply. And this year we have 5.1 months of supply. So we're actually down almost 8% versus last October. And we're actually down versus September, where our inventory was up in the 7-month category. So not to repeat myself, but we are like slowly seeing a decline on the listings on the market. And again, that doesn't mean that they've sold through. It could mean as well that landlords have decided to hold their property, or people have taken their condo off the market, or some people have sold their condo. So there's like different things that could be happening here. But the less inventory we have means less supply, and we have less supply. That means that we have healthier prices, generally speaking, when we look at basic economics here. And then you can see, and we've lived through these markets, how low supply has been in other conditions. So when you look at October 2019 or October 2016, like we were hovering in like 1.6 months of condo supply. Like that is nothing. And that was when we were seeing the environment of multiple offers, people outbidding one another, agents running around and listing properties and not putting $1 into their marketing strategy and taking a picture from their iPhone of an upside down toilet, posting it on House Sigma and MLS, and then the property would sell with multiple offers on it because there wasn't that much demand because we had so little supply. So with 5 months of inventory out there, there are opportunities, buyers out there for you if you want to look at condos. I'm not trying to sell you a condo right now for everybody in the comments. If you don't want to buy a condo, you don't have to buy a condo. But if you do, or you're interested in getting in the market, this is a very healthy time to be looking for quality inventory in great locations with long-term potential upside, healthy maintenance fees, and a place that you can start climbing the property ladder in Toronto. If that is something that you want to do for yourself, this is a good time to be taking a look at what's out there.
To your point about, the word on the street, I don't think you'd be hard pressed to talk to someone who feels richer today than they were, 3 or 4 years ago. I think that's just the reality of it. everything costs more. There's a lot of financial stress. Interest rates are quite a bit higher than they have been over the last, call it, last 10, 15 years, taking the last couple of years out of the equation. We're still sitting with fixed rates in the low fours. We've got a prime rate, which has now dropped from its peak at 7.2 to 5.45. But you still have clients that are in variable rates in the mid fours, which, in the grand scheme of things, looking back over the last 30 years, doesn't sound terrible. But if you look back since, say, 2010, it's definitely on the high side. These cuts definitely do move in the right direction. I did some quick calculations. If someone has a $750,000 mortgage, where they were at, if say they were at prime less 0.8, which is a pretty standard variable rate, back in before June, the rate cut, their payments would have been $46.50 a month. Their same payments today, based on these rate cuts, are now down to $38.47. So it's a pretty significant drop. This definitely will move to help ease some of that financial burden. Where things go from here is really anyone's guess. To your point about mixed messaging, obviously seeing, jobs created but unemployment go up, it's like, when you look at the numbers, you have to dig in more than just looking at the headline. I think we're looking at, potentially seeing some further, I wouldn't say significant, but potentially significant reductions on the variable rate side. And at the same time, we've got upward pressure on fixed rates. So fixed rates, it's a common call that I get, every time we see a 50 basis point rate cut to the overnight rate, did my fixed rate go down by 50 basis points? The answer to that is simply no. Keep in mind, fixed rates, move, in anticipation of what the central banks are doing, not just with the Bank of Canada, but the US. And, we saw an inflation read from the US today, and seeing inflation, creep up. And so even though, we saw a 50 basis point rate cut to the overnight rate, yields, bond yields, which are what fixed rates are loosely tied to, and track US Treasuries, are actually up. So there's actually been a little bit of upward pressure over the course of the last, not just today, but even over the last month as, Trump talked tariffs and things like that. I think we're in a spot where we could potentially see fixed rates tick up, even though we're seeing the overnight rate go down. And obviously, we're starting to now get to that point where variable rates and fixed rates are almost on par. And, 6 months ago, variable rates were 1.5% higher than where fixed rates are.
Well, I think there's a lot of smoke and mirrors going on when it comes to the economy. And I think that the people in power trying to stay in power and remain in control are giving, in my opinion, a very false narrative. I mean, yeah, we just saw a 50 basis point reduction, but the odds of that 2 or 3 weeks ago was, 10, 20%.
Yeah.
We moved right up to 90% once this unemployment data came out. And if you break out the data, okay, great. We created 51,000 jobs, 45,000 were created by the government. That's not the sign of a strong or vibrant economy. Neither is it when you have 6.8% unemployment with 1.5 million Canadians currently out of work. And if you look at Toronto or the GTA, we're up to 10% of unemployment. So I think you have a lot of pressures on the economy right now that people just don't want to talk about. If you look at the labor force participation rate, we're at 64%. We haven't seen something that low. And so it's from 1997. If you look at wage growth, we went from 4.9 a year ago down to 3.9. So there's less people working. People are being paid a lot less. Insolvencies are going up through the roof, both individuals and corporations. We've seen productivity falling. We're down again. I think it's another 0.4%. We have the lowest productivity in the GDP in the G7 statement. I think in the summer came out by the Bank of Canada saying it's time to break glass because it's such a dire situation comparative to every other country. Our GDP per capita has plummeted 8 quarters in a row. All this is just being paced over by immigration, and that's now being significantly brought down, which is the one thing that's been keeping us buoyed. So, I think our economy is a lot worse than a vibe session. And I think it's a disservice and a distraction to Canadians thinking that we're really stupid, and $250 at a cost of, I don't know, $5 or $6 billion to Canadian taxpayers is going to resolve anything, or even more importantly, get them reelected. And so I understand Tiff's position more, who's the current governor of the Bank of Canada. He has to present, a sense of calm. But I think there's a lot of layers to the economy that are really struggling. And I would think that the lower class and the lower middle class right now are the ones bearing the brunt of it. Those not holding assets, who don't own NVIDIA stock, who don't own gold, who don't own Bitcoin, who don't own their own houses, they're falling further and further behind. And so I see the economy very similar to what happened with COVID, where you have the rich getting richer and everybody else falling further and further behind, and nobody's even talking about it. And I think this is another move by the Bank of Canada to try and offset or address some of this. But I think these pressures are going to be going on for quite some time.
I agree. I think it's like, when I look at this as a mortgage broker, it's skewed on what I see day to day. Unfortunately, people on the lower end of the income spectrum are not purchasing houses. And so you have this false, belief that everyone's doing well until you actually start to talk to people in the real world, right? I mean, if you're in a position and you're fortunate enough that you're able to purchase a home, well, obviously, the state of the economy is impacting you. It's not impacting you at the same proportionate rate as someone that's on the lower end that's, trying just to make ends meet, keep a roof over their head.
And where do you see this heading?
I don't know where we see it heading. A change in government next year, some sanity maybe being brought back into things.
That'd be a really great place to start. I know there's career risk in talking politics in public in an open forum, but there comes a point where if there's no more country, if there's no more wealth, I mean, the disparity between Canada and the US, if you look at gross GDP per capita or productivity, we're literally like falling off a table comparative to the US, which is moving up to the right. And I think this is only going to continue. And we clearly are not moving down the right path. So I think that definitely would be some help in the right direction for sure. And the thing for me that's so frustrating is this is such an incredible country. This is such an incredible city. There's so much unbridled raw potential here in Canada. And it's just a shame when you see the data and then you see what they're trying to spin off on us. It's frustrating and it's angering when, you look at the bottom line numbers and you realize that if it's bad, but let's just deal with it. And we're still not really addressing it. I think this move by the Bank of Canada is very, very helpful in trying to address it. But I think we're going to see continued rates coming down for the better part of next year. Like where do you, if you were to guess, where do you think the bottom of the cycle would be?
So right now, the overnight rate is at 3.25. Tiff did say, expect a more gradual decrease in interest rates. At the same time, both BMO and RBC came out today. BMO forecasted another 75 basis points in cuts by mid-2025. So that would bring prime, if we're at 5.45, that would bring prime down into the mid-4s. So pretty great. And RBC is saying we will see another 1.25% in reductions, which, if that's the case, would bring prime to 4.2%. So
where, in your opinion, where a year from now, we'll play this again.
Yeah.
Go out for dinner. Where do you think the bottom of this will end up?
I would probably say we see another 75 to 1% in cuts. The unknown wild card being, south of the border. If we see tariffs, then I think we'll see more than 1.25% in further reductions. I think that's the unknown wild card here is, how, what we'll have to do. I was reading a report from an economist that said if the tariffs come into play, we could potentially see the Bank of Canada slash rates by 1% in an emergency session.
But what I do think, like last year, I'd say like in the summer, when rates started to come down, I was thinking the end of the cycle would be 2.5%, and people thought that was aggressive and I was kind of crazy for saying it. But I'm looking at things today and I'm thinking that's not nearly aggressive enough. If 2.5% is considered the neutral rate, I think we're ending up sub 2. I think we're going to end up like 1.75, somewhere in around that range. especially if things don't continue to get better, or if the discrepancy between Canada and the US continues. Now, that will devastate our dollar. Go away now on vacation if you're watching this, because I think it's going to get more and more expensive to go anywhere. But like, where do you see that landing right now? It's impossible to know, and I'm sure both of our predictions will be wrong, but that's the way I see it.
The Bank of Canada put a report out in 2029 on the potential for the impact of the economy on if there are tariffs from the US. And they said off the bat, I was just reading that 25% reduction, the value of the Canadian dollar.
But it's interesting. I read this other report, and it was talking about how when US GDP is above 2%, Canada has never had a recession, ever. So I do think that the US is set economically to really, really take off. I mean, the talk about vibes, the economic vibes in the US is extremely bullish right now. And if that continues and actually comes into fruition, they may help keep us buoyed, even though our dollar will continue to sink. So interesting time. So what are we talking? Fixed or variable today?
Not a one size fits all approach. You know, I think if you're willing to gamble a little bit, I would myself personally say that a variable rate at this point, as the gap narrows between variable and fixed, it starts to look more attractive, right? But for someone that's on a fixed budget, doesn't have a lot of disposable cash, you know, they're really kind of, more focused on a fixed income. The fixed rate obviously affords you some guarantees that the variable rate doesn't. And so again, it's not a one size fits all approach, but for someone that's buying well within their comfort zone, not stretching themselves at all, and feeling like they do have a bit of wiggle room, and the willingness to gamble a little bit. Now, the question I ask someone is, are you going to lose sleep if you take a variable rate? And if the answer is yes, take a fix. Don't think about it, take a fix. That's the consideration. But for someone that maybe has that ability to stretch themselves a little bit and go out on a limb, I think that variable rate will pay off. And at the very least, what it will do is it will at some point end up pushing interest rates on the fixed rate side hopefully down a little bit. We'll see what happens next year.